All right, everybody. So today we are going to be talking about the ample reserves regime. So we've already talked about the limited reserves regime. This is the updated version of what the Fed does, and it's going to be split into kind of two different parts. The simplified version, what the AP test wants you to know, and the real-life version. So if you take this course in college or continue on in economics, you'll know what's happening in a more real sense. So let's get to it. First of all, the path that the Fed takes to affect employment and inflation is going to be the same whether it's in the limited reserves regime or the ample reserves regime. Basically, the Fed wants to target an interest rate in the federal funds market. It announces what that rate is going to be, and then it implements policy in order to get there. After it implements that policy and affects the interest rate then affects consumption and investment spending, which therefore affects aggregate demand, which therefore affects inflation and unemployment in whichever way the AP test wants it to go. So, in the ample reserves regime, we are much more concerned about the reserve balance accounts and how they are going to affect the federal funds market and how they are going to affect interest rates in that market. So the reserve balance accounts, you'll recall, is the money that banks keep on reserve at the Fed. So remember, the Fed is like a bank's bank. So like you put money in the bank, the banks can put money at the Fed. And just like you earn interest on savings accounts and things like that, banks can earn interest on the money that they keep at the Fed. Now, that money that they keep at the Fed, they can actually lend out to each other as well. And that is the federal funds market. That money that they keep at the Fed, but they have the option of lending it out to each other. That's the federal funds market. And the interest rate they charge each other is the federal funds rate. This is a market-based rate, which is going to be different for each bank and how they lend it out, and it's going to be a basic supply and demand model for that federal funds market. We are going to skip watching this video in this lecture, but if you're interested, this video does break down the federal funds rate pretty well, so go back and watch it if you want. So, in the ample reserves regime, we are going to talk mainly about the federal funds rate because it is the Fed's policy rate. You might see that terminology come up. So their policy rates, they're either going to announce it goes up or it goes down, and that is what's going to trickle down and affect the economy. It really is the federal funds rate. And how are they at this? These charts that I'm going to show on this slide and the next are really going to show you how effective the Fed has been at maintaining that federal funds rate when they announce it. So these gray boxes show you their announced federal funds rates that they want to keep it in, the range they want to keep the federal funds rate in. And this red line shows you how they've been doing at it. And as you can tell, they keep that red line within that range almost entirely throughout this chart. It very rarely breaks. So we're now going to look at the policy implementation, and this is where things diverge a little bit from the limited reserves regime that we previously discussed. So this is the monetary policy with ample reserves money market. It should look very familiar to you. You have the supply curve still being vertical. You have the demand curve. It looks a little bit different. In this case, it is going to be horizontal at the start, and that is going to be defined where the discount rate is. It's then going to be downward sloping, and then it is going to go horizontal again where the federal funds rate is. Now, for the AP test, the IORB rate and the on-RRP rate, you don't have to worry about. We'll discuss them later in this video for your future self and general understanding, but for the AP test, you don't have to know about those two rates. The axes are going to stay the same as the money market. I know they're not necessarily labeled that here, but it'll be interest rate on the Y, quantity of money or reserves on the X. Now, one thing you'll notice is that the supply curve is on the right-hand side of this graph. For ample reserves, that's where the supply curve should always be. It should always be on the horizontal portion of the money demand curve, that you see there. If it was on the downward sloping portion, that would be the limited reserves regime. And that is not what we are going to be looking at. So always keep the money supply curve on the right-hand side there. Now, what does the AP test want you to know about this graph? The discount rate serves as the upper bound. The policy rate is the federal funds rate. They're going to announce whether or not that increases or decreases. And the open market operations are only existing to keep it in the ample reserves. This is sometimes something that could come up. The idea that the open market operations are carried out, how does that affect interest rates in the ample reserve regime? The answer is it doesn't affect interest rates. If you increase the money supply in this case, the federal funds rate doesn't change. If you decrease the money supply, as long as you're keeping it in the ample reserves regime, you are not changing the interest rate as well. So you only use open market operations just to maintain the ample reserves regime. So keep it on the right-hand side of this graph. So I'm going to go diverge a little bit here into non-AP stuff, as I said before, and then I'll return to how it affects the ADAS model. So the main policy tools of the ample reserves regime, you have four. You have the interest on reserve balances, the IORB rate comes from that. You have the overnight reverse repurchase agreement facility, the on RRP rate is going to be associated with that, and the discount window, which we've already talked about, and the discount rate evolved with that, and open market operations. So we're going to talk about each one of these things. First, the IORB rate. This is the interest rate that banks earn on money deposited at the Fed. So just like I said, you put money at your bank and you earn interest on that. Banks put money at the Fed and they earn interest on that. That's the IORB rate. This is the main rate that's going to steer the federal funds rate. So this is another video that explains that very well. If you want to go back, please go back and watch this. So how does the IORB rate affect the federal funds rate? Two concepts help explain it. The reserve rate, which is the lowest rate that banks are willing to lend out money for in order to earn something, and arbitrage. Arbitrage is a little bit more complicated of a concept, but still not that bad. Basically, it's simultaneously buying and selling funds or goods in order to capitalize on a price difference. So, to explain this further, banks have three options for what to do with excess funds. So when they have money that they don't lend out for some reason, they can either deposit those excess funds at the Fed and earn the IORB rate. That's safe, that's awesome. They can lend out the excess funds in the federal funds market, or they can invest the funds in T-bills. T-bills pay very low, so that's kind of a last-ditch effort, but it's very, very safe. So what would they do with excess funds if the IORB rate is higher than interest rates? So if the IORB rate is higher than the federal funds rate, they would take the IORB rate. It's always available and risk-free, so why wouldn't you do it? But they can actually do more to make money. So what would they do? Arbitrage. They would borrow from the federal funds market, borrow from other banks, and then they would take that money that they borrowed from other banks and deposit it at the Fed. When they do that, they then therefore get to pay a lower interest rate than they are earning. When morning rolls around, they just repay the loan and pocket the difference. So how does this therefore affect the IORB rate? So how does this affect the federal funds rate? Well, as banks borrow from the federal funds market, it's a basic supply and demand graph. As they increase borrowing in that market, demand for those loans will increase. As demand increases, interest rates, which would be the y-axis, increase. So that would increase your federal funds rate, yada, yada, yada. If it goes the other way, then demand would just decrease. Supply would then increase in this case, and we'll go over that later, but the basic idea is people would want to take money out of the Fed and put it into the federal funds market, which increases supply, lowering interest rates. Once arbitrage is done, the federal funds rate is the same as the IORB rate. So here's a sort of more visual example of how that works. So here you have a bank. It is earning, it will lend out, it can borrow money at 2%, and it can earn 2.5% at the Fed. So it borrows at 2%, deposits at 5%, earns a profit. The demand increase in the federal funds market increases that interest rate back up to that 2.5%. If it goes the opposite direction, now they can earn more money in the federal funds market than they can putting money on reserve at the Fed. So they withdraw money from their reserve account at the Fed and lend it at 3% in the federal funds market. As that occurs, supply increases in the federal funds market, decreasing your price, decreasing your federal funds rate. The other tools, you have the overnight reverse repurchase facility, the on-RRP rate. This is a supplemental tool that isn't as effective, but necessary because there are certain financial institutions that can't borrow from the Fed and can't take advantage of the IORB rate. So how they essentially do it is through buying and selling of other assets with the Fed. This creates a subfloor. So it's basically a loophole to help out those other financial institutions. So it affects the same way as the federal funds rate, it affects the federal funds rate the same way that the IORB does, but through a just different method and just for special case scenarios. The discount window serves as the upper bound. Now, this just means that banks aren't going to be willing to borrow from each other in the federal funds rate if they can borrow from the Fed for cheaper. So that's why it sets that upper bound of the interest rates. Open market operations, as I already said, is conducted periodically just to maintain that ample reserves, does not affect interest rates. So here you see just a little animation, a cut in the federal funds rate target decreases the Fed's administered rates, which results in a lower federal funds rate. So it's, that shift down that you see. If it goes the opposite direction, they would raise the interest rates. So pretty much it's just announcing that they're raising these administered rates, which increases the federal funds rate, which therefore increases or decreases investment or consumption spending. So if we're talking expansionary policy, a decrease in the policy rate is the expansionary policy. This increases investment and consumption spending, increasing aggregate demand. Contractionary is the opposite. They increase the policy rate, which decreases investment and consumption, decreasing aggregate demand. So here's just a couple of practice problems. If the economy is weakening and employment is falling below maximum and inflation isn't something that you're too worried about, what does the Fed do? The policy tool they should do is they should decrease their administered rates. If they lower those administered rates, that therefore increases aggregate demand through increased investment and consumption spending. If it's the opposite, if inflation is rising but unemployment is still pretty low, then since you're worried about inflation, you want to decrease aggregate demand. If you want to decrease aggregate demand, what should the Fed do? They should raise their administered rates. If they raise their administered rates, this trickles down through the economy, saying that investment and consumption spending would fall, which decreases aggregate demand. And that is it for the ample reserves regime. Hopefully you found this a little bit simpler than the limited reserves regime, which has a little bit more complicated view of open market operations.